For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. It was another roller coaster of a day for Wall Street, as major indices started the session on a downward slope rattled by concerning economic figures, but managed a modest recovery by the close. Although the gains were not enough to erase the day's earlier volatility, the final hour rally helped cap off what has been a dramatic and unpredictable month of investing. The stock market's choppy behavior mirrors growing macroeconomic unease, with investors caught between softening inflation and worrisome signs of a broader slowdown, exacerbated by looming tariffs and geopolitical uncertainty. One of the clearest signs of economic stress came from the energy sector. Crude oil prices recorded their largest monthly percentage decline since back in 2021. Analysts attribute this decline to mounting fears over a slowdown in global demand and recent indications from Saudi Arabia, one of the world's leading oil producers, that it is willing to tolerate significantly lower prices in order to preserve market share. This shift from Riyadh sent ripples across global energy markets, adding another layer of instability to an already fragile economic environment. Beyond commodities, the U.S. economy itself is showing increasingly visible cracks. Today, the U.S. Department of Commerce released its preliminary reading on gross domestic product for the first quarter of 2025. The data showed a surprising contraction of 0.3%, a stark contrast to the 0.4% growth economists had forecast. More notably, it marks a dramatic decline from the 2.4% expansion observed during the fourth quarter of last year, and it's the first time the economy has shrunk since the first quarter of 2022. This negative GDP print underlines a significant shift in the momentum of economic growth. While some sectors had managed to remain resilient despite tighter monetary policy and international headwinds, the latest data shows that these buffers may be eroding. Despite the GDP contraction, one area that held up, albeit weakly, was consumer spending. This category, which makes up roughly 70% of total U.S. economic activity, increased by 1.8% during the quarter. Although that marks its slowest pace since the middle of 2023, it suggests that consumers still found reasons to spend, likely to get ahead of anticipated price hikes due to tariff threats. On the business front, corporations rushed to stockpile goods in anticipation of upcoming tariffs. That urgency drove imports up by a staggering 41.3% during the quarter. Meanwhile, exports inched upward by only 1.8%, leading to a sharp deterioration in the trade balance. Compounding this imbalance was a noticeable reduction in federal spending, particularly linked to scaled-back initiatives like Elon Musk's space and crypto-related ventures, which had been receiving experimental funding. Together, these factors added substantial downward pressure on GDP growth. Looking forward, concerns are growing that this might just be the beginning of a deeper slowdown. As more of the announced tariffs take effect, their full impact is expected to ripple across supply chains, pricing, and consumer confidence in the second half of 2025. According to Brian Rose, senior U.S. economist at UBS, the current contraction isn't alarming in isolation. He pointed out that even in 2022, when the economy contracted in the first quarter, the full year still ended with a robust 2.5% expansion. However, Rose warned that the real concern lies ahead, with tariffs potentially dragging down growth much more severely in the coming months. Meanwhile, political rhetoric is heating up in the face of these economic headwinds. Trade advisor Peter Navarro, known for his controversial views, tried to put a positive spin on the data by calling it the best negative print I have ever seen in my life, a comment that drew a mix of confusion and criticism from analysts. On the inflation front, there were mixed signals. The Commerce Department also released updated figures for the Personal Consumption Expenditures (PCE) Price Index, a key measure of inflation tracked closely by the Federal Reserve. In the first quarter, the headline PCE index rose at an annual rate of 3.6%, up significantly from the 2.4% seen in the fourth quarter. Core PCE, which excludes volatile food and energy prices, climbed by 3.5% in the same period, compared to 2.6% the prior quarter. These quarterly numbers suggest that inflation, while not surging, remains stubbornly above the Fed's 2% target. However, more recent monthly data tells a slightly more hopeful story. In March, year-over-year inflation as measured by the PCE index came in at 2.3%, slightly higher than the consensus forecast of 2.1%. Still, on a month-over-month basis, both headline and core PCE inflation remained flat, below February's increase of 0.4%. That deceleration, especially in the monthly figures, is a sign that inflationary pressures may be losing steam. Ordinarily, such data would be interpreted as good news, evidence that the Federal Reserve's rate hikes are working and that inflation is inching closer to its long-term goal. But this was no ordinary day. Investors and analysts found little reason to celebrate, as a cloud of uncertainty continued to hover over the economy. Consumer sentiment has dropped sharply, and executives on earnings calls have been notably cautious, with many offering vague or no forward guidance at all. In the stock market, individual company earnings painted a similarly conflicted picture. Seagate Technology was among the biggest gainers, soaring by over 11.5%. The company posted solid quarterly earnings and raised its guidance, reassuring investors that potential tariff disruptions would be minimal. Another strong performer was Wingstop, which jumped by more than 14% after delivering an impressive earnings report that beat expectations across the board. General Electric Healthcare Technologies also posted gains over 3%, even though it lowered its forward-looking projections. Caterpillar, a bellwether for industrial activity, inched up by just over 0.5%. While the company raised its revenue forecast for fiscal 2025, it also warned that it expects to absorb about $350 million in additional tariff-related expenses over the year. But not all companies had a reason to celebrate. Supermicro Computer suffered one of the worst declines of the day, plunging by over 11% after issuing bleak preliminary earnings and warning of further weakness in upcoming quarters. Even Nvidia, one of the market's recent darlings, experienced a modest dip, less than 0.1%, after receiving its first sell rating from a Wall Street analyst. Etsy dropped by more than 5% despite beating revenue forecasts. The e-commerce platform failed to meet profit expectations as its active user base continued to shrink. Snap was hit particularly hard after expressing concerns that economic uncertainty could negatively impact its advertising business. The company also withheld forward guidance, leaving investors in the dark. Brinker International, which owns Chili's, fell nearly 2% despite solid results, as concerns about softening consumer demand weighed on the stock. Norwegian Cruise Line tumbled by over 7% after posting weaker than expected results and warning of a slowdown in bookings. In labor market news, a troubling update came from the ADP National Employment Report. The U.S. private sector added only 62,000 jobs in April, far below the 125,000 economists had predicted, and less than half the 147,000 added in March. Dr. Neela Richardson, chief economist at ADP, described the environment as one of unease, with employers struggling to reconcile positive macroeconomic indicators with lingering policy uncertainty and shifting consumer behavior. The labor market remains a critical point of focus for Federal Reserve officials, particularly Chair Jerome Powell. The Fed's dual mandate includes promoting price stability and maximizing employment. With inflation showing signs of cooling, albeit slowly, the job market is now under scrutiny. Powell will likely be watching Friday's upcoming employment report with intense interest. In addition to the ADP report, yesterday's job openings and labor turnover survey revealed that job vacancies had declined to their lowest level since last September, another signal that labor market strength may be waning. Elsewhere in earnings, Visa rose by over 1% after beating expectations for its second fiscal quarter. The credit card giant reported an 8% increase in payments volume and a 9% rise in processed transactions. Even with consumer sentiment hovering at its fourth lowest level since the year 1952, Visa CEO Ryan McInerney noted that Americans remain surprisingly resilient spenders. Visa delivered earnings per share of $2.76, outperforming analyst projections of $2.68. Revenue reached $9.590 billion, slightly ahead of the expected $9.550 billion. In contrast, Starbucks experienced a rough quarter, with shares sinking more than 5.5% after the coffee giant posted disappointing results. Despite a menu revamp that eliminated 13 drinks and operational changes aimed at cutting wait times below 4 minutes, the company reported its fifth consecutive quarter of declining same-store sales. Many consumers have opted for more affordable coffee options at rivals like Dunkin' and McDonald's. Starbucks reported earnings per share of 41 cents. Falling well short of the 50-cent estimate. Revenue came in at $8.760 billion, also below the expected $8.850 billion. Lastly, First Solar, the largest publicly traded solar module manufacturer in the US, tumbled over 8% after releasing disappointing first quarter financial results. The company slashed its sales and profit guidance for the full year of 2025. Although analysts previously believed the company was protected from tariffs due to its domestic manufacturing footprint, CEO Mark Widmar acknowledged that international facilities are experiencing substantial challenges. Some factories may be forced to reduce or pause operations until macroeconomic conditions improve. First Solar posted earnings per share of $1.95, far below the $2.50 expected. Revenue was slightly better, reaching $844,570,000 compared to the forecast of $839,270,000. In summary, today's data and market action reflect an economy walking a tightrope. Inflation is slowly easing, but economic growth is faltering, and job market cracks are beginning to emerge. With tariffs set to escalate in the coming months, uncertainty remains the dominant theme. Investors should remain cautious, stay diversified, and keep a close eye on the labor market and upcoming Federal Reserve decisions. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.